So technically, how are things stacked up for us, and in terms of market fundamentals, where is deep value in this market? Let's discuss that with Ashwini and Mahesh. Gentlemen, good evening to both of you. Thank you for joining us. Ashwini, a sluggish day. I won't like to use the word disappointing, but in terms of price action, in terms of volume action, the momentum clearly was very tepid.
Well, momentum is tepid, and chances are that we need more sideways consolidation. We are slowly getting back into that 58.30, 59.60 kind of range. So no problem yet, and it seems that market needs lower levels and maybe some more sideways movement before we can take key levels on the upside. So that's the way it will be for this January. Januaries are generally known for being extremely volatile, and if we can consolidate here right underneath 6,000, say from 58.50 to about 6,000, that wouldn't be such a bad outcome, because taking new highs out is not such a simple thing. And if we can consolidate here and make a fresh base, the base right now I think is around 56. So if we can create these bases every 300 points, then maybe the market has a better chance of an upside.
Ashwini, so on a scale of 1 to 10, to your mind, what are the chances that Nifty will not scale up beyond 6,000 in the month of Jan?
I would say more than 50%. But the good thing is that some sector or the other is putting up its hand and preventing a fall in the market. See, the confidence will be destroyed if you start getting the 100-point declines on the Nifty. But as long as it's 10-15 points up and down, the confidence will be maintained and the market will be able to move sideways. So I don't think it's really that important, whether we cross 6,000 or not. What's important is we don't have these sharp falls, and I don't want to see 5,500 on the Nifty in January. As long as it's 58 to 6,000, we should be fine.
Mahesh, what is your assessment? 2012 indeed was a strong year for Indian equities. What's in store for us this year? Volatility, strength, or absolute gains?
Well, 2013 we feel, last year the market actually mean reverted. Market ran up ahead of the economic fundamentals. This year we see the macroeconomic fundamentals catching up. So we see a mean reversion in a lot of the domestic macro fundamentals, whether it is the GDP growth, which hit a low of 5.5, to moderate up to around 6.25 this calendar year. Even interest rates, we expect around 75 basis point cut. And even the recovery, we see some recovery on the investment side led by the government push, and urgency in terms of revive the whole investment climate going forward. So this year actually we are seeing the cyclical downturn what we hit last year. We see some kind of a recovery over there and reverting back to mean in this calendar year. And even from a market standpoint, while the market is now already at long-term average in terms of the PE multiple, so we saw that PE correction re-rating happening last calendar year. And this year I think the market should by and large follow the earnings growth trajectory what the corporate earnings report in FY14. And there again we believe that the corporate earnings growth, which had also lacked the nominal GDP growth last year, should again mean revert to the longer term average trend, which is around 14% or so. So that should be the kind of return I think one can expect from the market, assuming there is no re-rating. And one good thing what we see is that the earnings downgrade cycle what we have been witnessing for the last 1.5 years, that's kind of bottoming out. If you look at last quarter itself, the number of upgrades and downgrades are kind of evened out. And there could be a possibility that as interest rates go down and those get factored in terms of the analyst expectations, we could see marginal upgrades also for the next fiscal year. So if that happens, then you could see some re-rating potential in the market.
Ashwini, cement today corrected and some key cement stocks have corrected. Just a blip or cement is looking shaky?
I think cement seems to have topped out. The reason for that is that it's breaking below its intermediate lows, which means that levels from where cement stocks rallied and touched their highs, those levels are getting broken. Something like Ambuja, it was in a range of about 195 to about 220. That 195 is giving way. So chances are that after the sideways move is turning into a down move. So I guess large players have booked their profits at higher levels, and there's distribution that's happened on the cement space, and hence stocks should be expected to correct from here.
Mahesh, at the current juncture, what is your understanding when it comes to expectations? Because a lot of hope is building up, hope that interest rates will come down, hope that earnings will bottom out. There is some assumption that investment or the capex cycle will pick up. But if I look at the ground reality is entirely different.
Well, I think, as rightly said, I mean, there is a lot of expectation in terms of things improving. I think the key risk for the market going forward, obviously the global macro, currently we've seen a pretty good environment, a risk-on kind of environment. All the indicators in terms of the CDS spreads for Euro region suggest that things are looking pretty okay. Even the fiscal cliff situation has been deferred for some time. So that still remains, the global macro still remains a concern, and we've seen especially in India, we are dependent to a large extent not only for the market but also for economy in terms of capital flows because of the high current account deficit what we have. So any change in that outlook and any reversal of the capital flows can put pressure on a rupee also in terms of a market. So that risk always remains. And more from a domestic fundamental standpoint, I think we are getting into a year. We have seen the government action in terms of policy, in terms of reforms. But a lot of things needs to be done at the ground level to really sustain that and to sustain the recovery for the economy going forward. And with elections in the second half of this calendar year, one has to wait and see if populism really takes over reforms somewhere down the line. If that happens, then yeah, that could be a kind of a area of uncertainty from the market standpoint.
Ashwini, before the bell, the cat's going to be out of the bag. Infosys numbers will be out. What's your gut call?
I think 2250 has held on, in all previous corrections, and given the relative lack of expectations, see, you can get disappointed only if you have expectation. If you don't have any expectation, then even a marginal positive can lead to a bit of a rally. So chances are it will go to the higher end of its range, which is around 2550, 2600. So I think 22 to 26 is the range. It was at the lower end, so the risk reward was extremely favorable today. With a 60-point type of risk, you could easily expect 150, 200 on the upside.
Ashwini, looks like investors cannot have enough and more of Tata Motors.
See, I am not too excited at this price. Why didn't the upgrade happen at 220? See, the problem is that because of this upgrade, everybody gets in, and the stock corrects 50 points. That is the big risk because 380 may not happen immediately. So I would want to see the stock come back towards 270, 280, and that will be a good buying opportunity from where you have a 20-point risk and probably a 100-point move on the upside. So while it has crossed its intermediate highs, we'll have to see how long 325, 330 is held on by Tata Motors.
Okay, IIP, what are the expectations according to the ET Now poll? IIP for the month of November 2012. Now IIP, bear in mind, is a very volatile data. IIP for the month of November, again, if you do a month-on-month comparison, could take a plunge from 8.2% to just about at 0.1%. Manufacturing could take a knock because manufacturing as a sector is yet to revive. Electricity, of course, will be an issue because there are hardly any coal linkages, And the mining output also in the month of November was rather weak. So in terms of core sectors, you should not expect a strong turnaround. High base effect, of course, will be visible in some of the capital goods stocks. And because November had some bunched of festivals, so obviously that will also have an impact on the overall IIP number. But the group which I want to discuss at length is PSU banking. Mahesh, what are your thoughts there? Do you think at the current juncture PSU banks qualify as a tactical buy? PSU banks are under-owned. If the economy recovers, bad loans could become good loans. And given the way how bond yields have moved in last 1 week, most of the PSU banks for current quarter, they could report strong profits.
Yeah, I think your observation is right. We have been positive on the private sector banks since more than a year, and mainly on the belief that these banks are able to manage the asset quality much better. And a lot of these banks are retail focused, where there is no real concern on NPA, unlike what we are seeing in the economic downturn on the corporate side, and that's where the PSU banks are largely exposed to. But going forward, we think the private sector banks will also continue to do well. It's not like they will falter. They have shown a steady earnings growth, and that will continue. Probably the PSU banks now, with the asset quality cycle really bottoming out, and with some recovery expected in the economy, and looking at valuations differential between the private sector banks and PSU banks, yeah, there could be merit to really start looking at PSU banks. But again, one has to be selective, because still we feel the restructuring, or the total amount of restructured loan, that's not likely to come down sharply in the next few quarters.